thank you guys to join this panel. And we are obviously going to talk some spicy topic about venture-backed tokens. And first of all, I think let's give a round of introductions of yourself and your companies. Maybe let's start with Chris.
Sure. My name is Chris Ahn. I'm a partner at Haun Ventures. Haun Ventures is a crypto-focused venture firm.
Steve from Neoclassic. We're an early-stage VC firm out of Miami Beach, and it's been 2 years. I worked before crypto fund Block Tower for 6 years, and before Goldman Sachs for about 9 years.
Jeremy Huff, founding partner at No Limit Holdings. We are a venture fund, early-stage venture.
I'm Colin Jones. I run Outerlands Capital, which is a liquid digital asset manager. And I desperately try to avoid buying stuff that these guys are shilling. So I think I'm the liquid guy up here. So.
My name is Dinghan. I'm a partner at Jsquare, and we're crypto VC with a few $100 million AUM. So let's get this topic started. First, I would like to get some comments and feedback from you guys. Like many people are saying, like venture-backed token becomes uninvestable after TGE immediately. So what's your opinion on this? What do you think triggered people to have this kind of opinion on the venture-backed tokens?
I can start. So I think there are many textbook answers, such as oversupply or things like that. But I don't think that's a main trigger, because those are things that exist in bull market or bear market 2 years ago, 3 years ago. So I don't think that textbook answer is really trigger for the poor performance of post-TGE. I think number one is everyone is looking for AI, robotics, those emerging technology more sexy, sort of the investment opportunity. Because those who invest in crypto, not like us who are convicted, many of them see the crypto as one of the asset class on emerging basket of their entire portfolio. So that's a number one. Number two is I think people are looking for quality assets when the bear market started. So Bitcoin and large cap, that's more intended to focusing on a capital deployment. So that means that more and less small altcoin is just after TGE, they cannot avoid poor performance. And number three, I'll stop. And I think people more care about less speculative but more solid metrics, such as traction or engagement or retention rate of the company as a sort of excuse for them to not to invest, or excuse for them to invest it in, even though they are new projects, they are still quality. They have a quality than other crypto projects. So it's more focused investing. Those are the three reasons I'll pick.
Thank you.
Yeah, I'll follow up. I think that there's a lot of problems here, right? And if you show people the incentives, right, they can figure out what you're going to do. And when venture capitalists get this other lever of launching a token, whether or not it's needed, launching it too early, not thinking about the tokenomics and trying to get it out the door, they get DPI back to their investors much quicker. That's great for their fund. That's great for their next fund. And they're trying to run and build a business. And this is a lever not available to traditional VC. And crypto VCs take advantage of it, and you can't blame them because that's their incentive. But the real problem is there's no demand for a lot of these tokens. They're just unnecessary. They get dumped on retail. This is deep tech that we're talking about. Retail is hopeless in trying to evaluate it, and there's not a big enough secondary market of people like us that are trying to buy quality tokens that can actually evaluate the project at hand on the liquid side. So we stay far away from newly launched tokens unless it's something truly spectacular, because they tend to be down only, and it's a very terrible dynamic. It's broken. I don't think anybody's evil up here, but it's just a bad dynamic that we need to fix as an industry.
Yeah, maybe one more thing to add is I think a good analogy for this is something like biotech, where with traditional equities that we might be familiar with, typically these companies are going public after they've achieved some sort of product market fit. And so there's healthy demand, a healthy foundation, but in something like biotech, that's not the case. And so it's still a very speculative instrument. It hasn't reached any sort of product market fit yet. And I think because of the nature of some of the crypto projects that we interact with, where decentralization is part of the point of the project, you have to be out there in the wild, and by definition, you might not be able to have product market fit by the time you launch the token. And so I think biotech is a better lens through which you can look at this rather than something like traditional equities.
And I would just add on to that point that in the biotech context, at least the speculation is linked to potential revenue that the company will generate in the future, and you can see clearly how that revenue will accrue to the equity. Whereas in the token market, it's not clear how the equity or how the revenue at the company, if it does in fact generate revenue from clear product market fit, accrues back to the token. So I think it also depends on the token. I think tokenomics and TGEs are very much broken in many cases. Where there are clear, where I've seen clear product market fit for tokens is on things like DPIN, where you can point to clear utility, where you're actually creating a commoditized unit that can then be used, for example, with Aether. You can commoditize compute and GPU. And so in those cases, there's actually something useful about the token, and it's clear where value will accrue back to the token holders. But if it's just a pure governance token, I think that the model breaks. And so I agree with the biotech example. I think that what happens with crypto is you go farther out the risk curve. Now you're speculating not only on whether or not the company will eventually get PMF, but also whether or not that'll accrue any value to the token.
Yeah, thank you. So follow up on that. So what do you, from your experience, what do you see in the market or in your portfolio companies? Like what leads to the design, like structural design flaws or success examples after the token TGE, right? Obviously, there are some successful case, some failure case. What are the leading successful case for a good performance token after TGE versus a bad token designs after TGE?
Yeah, I'll jump on it. I think you need to have a use case. So like I think you've got to have product market fit of some sort, and it's got to be tied to the supply overhang or the supply unlocks, which is rarely ever the case. And so you launch the token, whether or not it's needed at all. A lot of that's regulatory. So like you can't really blame people in 2023 for wanting to launch governance tokens. And we're seeing some of that change now. So that'll be exciting to see how the token, I think there was a panel earlier or later today on sort of token versus equity. That'll be very interesting to see, and I think that'll improve a lot of things. But you have to have measured supply that's kind of synced up with the demand that you're going to see for that token. And we rarely ever see that. And the truth is that it's because there's not much product market fit. And that's normal for venture companies. They're new, they're early, most of them are going to fail, except that there's this like liquid lever that crypto venture can pull and then create this token, launch it, get some liquidity, 6 months, 1 year, whatever the lockup is. I'd love to hear how long you guys tend to hold tokens, but probably not much longer because you want to get that liquidity. You still have the equity in the company quite often, the labs co, and then you distribute that back to your LPs. That's fantastic for building a venture business. I think we have to fix that. We need to have proper tokenomics. The token has to do something if you're going to launch it. There's way too many tokens, way too many projects, too much redundancy, and I don't know. There's probably just not enough good quality founders and projects building in the space. And the last thing I'll say is a dynamic that I don't think we can miss is that founders get very wealthy on these token launchers too, and launching a startup or being a founder is incredibly challenging and difficult. It's not all like strawberries and champagne. And when you've just made a whole shit ton of money and your tokens are about to unlock, it's really hard to get up and grind in the morning. And so it takes a very special individual to face that level of liquidity and stick with it, which I don't think you see as much in the venture world, in like the traditional venture world.
If I can jump in next, I think comparing to IPOs is a useful sort of thought exercise here. When you think about what's broken about TGE or what sets companies up for failure, in an IPO context, the company is selling shares to the public market in return for capital that goes to the company. They're not selling old shares. There may be people that participate in the IPO that are selling some of their investments, but typically it's the company raising a war chest to go out. They have a clear use of proceeds, and they will post-IPO go and develop new product. They have an extended runway to go and build new pieces. It makes sense that post-IPO, based on that war chest, you could bid the company up because they have a brighter future ahead with money and capital to grow. In the TGE context, there's no war chest created. They just continue to burn the VC capital that was already invested. So post-TGE, protocols have the same or less money. They've paid listing fees. They've airdropped to people. So you end up with a supply overhang. You have this VC supply overhang for however long they're holding. So I think in many cases, because of the TGE model, you end up in a worse position post-TGE for development. versus ICO. So I think there are opportunities to look at ICOs, fair launches. We've invested in companies in where there have been fair launches. We do tend to hold for a long time. Like we can come back to that, but
Liar.
I think that's where there's a big disconnect. I think we can learn some things from the IPO market.
I think a couple of things. Number one is incentives. I think the projects are more thoughtful giving the incentive on right after they start kind of a business. So oftentimes they give a bunch of incentive in front to get the speculative bubble, but everyone knows that that doesn't last. And then that's why we see after TGE, they don't have a bullets to incentivize because they all use them all. So you have to wisely use the incentive to the users, which means a short-term pain to get the long-term gain. Number two is a lockup. I prefer to see more bigger lockup, the vesting for the VC at the beginning of a TGE. So I'm not saying it should be 100%. It's a matter of a balance, but I think it should give more VC to kind of take off their offload at the beginning. Again, short-term pain for founders to get the long-term sustainable growth. And number three, I would say, is now some layer one, I think someone here, they are more focusing on to give a grant to those who have attraction and constant engagement that show, even though it's a small, whether they have a retention. So I think the layer one foundation have more responsibility, not to give a grant for a speculative potential opportunity, but giving the grant only when they need it, and then giving them when they show the real traction in terms of engagement and retention level. The last thing I would say is more communication. So everyone talk about VC and TGE, but you have missing one critical player, which is a liquid fund. You have to, I mean, after TGE, those who are buying those tokens is not a VC. You have to get sexy appeal to those liquid fund. But I think people are missing that part. It means that, I mean, he's an expert on traditional finance part, but no crypto projects doing IR. What is IR? You have to do the investor relation job when you become a public. Same as you become a equity, your equity got listed on stock exchange. You have such a big responsibility for the retail investors or institutional investor to let them know where you guys are, what kind of challenge you are having, what's the guidance of the next quarter. Of course, you can't have that much sophisticated detail like a stock, listed company, but still you should put the effort so that you constantly engage with the public market players such as a hedge fund and so on, so that they are learning, okay, they're doing progress, so even though it's not a good entry point right now, but they get your name on the list of watch list, so that when the market is down like this, perfect entry point. So those are the four things that I want the crypto early stage projects to work on more.
One thing that I'll add to this is I actually think the most important characteristic is resilience. So, I mean, Figma, as a public stock, it's a company, I think, that was founded in 2012, so it's 14 years old, generates hundreds of millions of dollars of revenue a year. Their stock is down something like 70, 80% from all-time high because they had this massive pop at IPO day. You don't see the Figma team folding because their stock is down 80%. And I think this is just the reality of the markets. Like once you're public and once you're out there in the markets, it's not unusual to have a day where you're down 5% or up 5%. Maybe, the macro is not great, and so you're down 50%. And so you could name many, many stocks out there that have gone through these massive volatility moments, down 80%, up 5x, all in a matter of 3 years. And I think that resilience matters a lot. And I think oftentimes, I think we place so much emphasis on the token price and kind of forget that these projects are supposed to operate and service users regardless of what the token price is.
Thank you. Very insightful. And next, I would like to talk about it's related to token price, but fundamentally it's a valuation, right? So it seems there's a disconnection between the primary market valuation on projects and the secondary market once TGE on the valuation of the company or on projects, right? So no matter whether it's in the bull run or in the bear markets, I think not all the projects, but a lot of projects are overvalued in the opinion of the secondary markets. So that's why we see the sell side pressure on the TGE date. What's your feel about that? As a primary market investor and secondary liquid funds. Like, do you think there's a mismatch between primary markets and secondary markets, or institutional market versus retail markets? Who's right, who's wrong? Or yeah, just want to hear from you guys.
Well, I can kick off and just say I think valuations on the primary side have gotten overheated and have not come down as much as they should have to react dynamically to the market. I think it's awkward to go into, for example, a 100 million round or a 200 million round or anything north of that in a market where altcoins are trading at a 700-800 billion market cap, and then expect that the TGE is going to make any sense in terms of a venture return. So if venture investors are looking to underwrite to 10x or higher, then they need to push valuations down. So I think that's a responsibility on the venture side to work with founding teams to have lower entry valuations, not in order to make more money specifically, but to have a more reasonable TGE so that the public market can have reasonable float and price discovery can happen in the public market. Because the reason that we use a safe instrument is because we are bad at price discovery at the venture early stage. So I think it's important if you don't have revenue, it's very difficult to come to have real price discovery. So I would say lower valuations will help fix that.
First, I agree with his point. Number one, I think a huge responsibility for VC side. Because the VC just deploy irresponsibility, raising the price up. I think that's how the price gap is larger. However, those who LP, which is investor of the VC fund, is giving them money because this industry is speculative opportunity they see. So whether 100% VC responsibility, that's not sure. Because LP gave you a lot of money on that market is a peak, so actually investors have to deploy. That's why mutual fund always cannot beat the index fund, because people are giving you money at the top, but they have to deploy at the high price. So my point is the investor of a fund is responsibility, and VC have a responsibility. Also, there is a responsibility of founders. I want to make one point. Again, back to communication between public market and private market. Liquid fund people are just talk about token trading and then taking a trading and taking a return and so on. VC people are vision oriented, founder focused, long-term vision. The problem is in traditional world, private market, public market has an 8 years gap. Facebook from Harvard dorm room to NASDAQ listing for Goldman Trader trade, it took 8 years. But in crypto, 8 months. So this private sector investors player with the people focused long term, and then trader kind of public market players, we have to making a return today for ROI for this month. LP care about month to month return. So they are overlapping. However, they are not communicating enough. But I think one part of responsible founder at the middle of those two sectors is they have to communicate clearly and transparently for when they are raising, they have to raise at the appropriate price level, and so that liquid fund players, when they become a TGE, they can easily enter to buy the token. So I think basically all players have a responsibility, but I think it's a matter of a balance.
I think that's well said.
Can I ask a question? I'm sure nobody on the stage pushes founders or anybody to launch a token early, the 8-month time frame, which makes no sense. Why do we keep seeing that? Yeah.
Because sure, I think the beauty of token, everyone is criticized whether token is necessary in crypto market. I personally think a token is the present of this Web3 technology. By having token, you can give the utility, give back the ownership to the users and such. I think a token is a beautiful product, but at the moment, speculate wave is way bigger than actual utility. So as long as we have a token, I think 8-month frame, which is a relatively super short and TradFi, but I don't think that is wrong. It's just a matter of how we want to design, how people treat the tokens matters.
I think there's a couple of things that are just artifacts of history, right? I think part of it is that because of the regulatory environment that crypto grew up with over the last couple of years prior to this administration, the idea of having sufficient decentralization probably carried a greater share of the decision to launch a token than some of the other factors. We will see how that plays out. But I would say that these are market distorting factors. It was not a purely economically rational decision. I think there are other factors that also push it in that direction too.
So do you think we'll see less of that kind of rush
I
to
think
the
a bull
decentralization?
market is going to be short again, and bear market is going to be long again.
I mean, we're spending time negotiating with founders when we invest to make sure that we have some control over preventing TGE that's premature. Because from our perspective, a premature TGE at a high point that then drops while we're locked up doesn't achieve our goals. So it's not value accretive for my investors if I push it. If I were to push a project to go out early, and then the token went down over the 12 months that I'm locked up, it doesn't help me. So I'd much rather see real PMF, revenue generation, some strong metrics that would allow the token to grow over time, so that when I get out of my lockup, just from pure incentives perspective as a VC, I need a token that lasts for at least 12 months. And in many of these cases, what you're seeing is within the first 12 months, that, because of unlocks or premature lack of PMF, you end up with this, down chart. So I think we're certainly not incentivized to push things out too early. Is my view.
So are you insisting on longer lockups and slower unlocks?
I'm not insisting on longer lockups, but I am insisting on PMF before TGE.
I think it's not about longer lockups. I think it's to launch the token when the product is mature. I agree on that. And also, if we look at the traditional IPOs, right? There's no such thing called lockup vestings for 3, 4, 5 years. Why? It's because most of the company are more transparent. They have to provide enough information to the public, and they have to generate revenue. Then they will be listed on NASDAQ or NYSE. So I think that's a biggest difference. I think still most of our TG projects are not transparent enough, right? Because as someone mentioned just now, there's equity part, there's foundation part, there's foundation treasury, there's airdrops, there's a lot of buckets for tokens, and nobody really knows, including VCs and insiders knows exactly what's going on. Probably only the founder himself knows what's going on with those tokens. So I think this lack of transparency needs to be improved in our industry as well. And next, I think Steve mentioned about the structure of the VCs, right? And I would like to discuss about what's the VC's roles after the TGE. How can VCs help this? Is there a mismatch between crypto VCs and then the time frame for the projects? As you mentioned, some LPs give you the money at the very top of the markets, and you have to deploy. And also, VC have a lifetime span of the VCs, right? You have 3, 4, 5, 7, 6 years. So you have to exit at some point in time. You have to sell the tokens, right? So how do you balance this after a project is TGE, so that you are not VCs are not destroying the price of token and keep continuing support the projects?
So you're asking basically between in terms of how we sell the token versus how we add the value to.
Yeah, and also do you think there's anything structurally wrong about the crypto VC setup? Because we have we have this fixed term, whether that's 4 years, 5 years, or 6 years, right? So and then if we have lockups for, let's say, 3 years on a project, that almost means after you invest on a project and then lock up for 3 years, you need to exit immediately because your fund terms are up, right? You have to return your capital to the LPs in 5 years, right? So do you think there's something needs to be changed in this structure, or?
I don't think so. I think still for investor of those funds perspective, still way better than traditional VC. They have a way shorter the liquidity. So I don't think it's wrong with it, because basically this fund exists for LP. I mean, in one way, because they give us money to do business. So for them to satisfy, I think its current structure is still way better than traditional VC. So that's why I don't think there's nothing wrong with it. However, number two, I think it's a very delicate process for VC. We are always get challenged about selling token versus adding value token. So we try to always be sophisticatedly delicate in terms of pushing founders to execute the outcome. But if they don't do that, multiple times. We have to making a hard decision that okay, then you don't deliver stuff. We have a LP that we have to taken care of. Then that's when we want to start selling the position. So it's a very delicate balance process for VC.
I'd say venture capital actually is designed to be long-form capital. So definitionally, there's nothing wrong with that. If anything, I think you'll find it, the only longer form of capital that you're going to see is like a life insurance company that wants to underwrite something for 30 years. And so a 10-year fund life is actually an incredibly long amount of time in the context of a fund. And so I don't think definitionally and structurally there's anything wrong with it. And if anything, I would guess that, we talked about the 12-month lockup, and one of the things you don't want to do is rush a project out to market, and then you're locked up while the token is just going down 80%. And I can tell you that that's happening faster than the fund's life. And so, for a venture capitalist, I think you would love nothing more than to see a project thrive and for you to want to hold on to the token. And so I think our incentives are actually aligned in the right way. It's just that the reality of venture is that 90% of projects don't make it. And the reality is that there are far more projects going out and releasing a token than that 90% rate, which is kind of the natural death rate of companies.
I think a main reason why those kind of question arises is answer is I think there's no right and wrong, but because a lot of people care about look at the market as a public market and lens when we're talking about private investment. In Web 2 side, this Silicon Valley amazing, the investor like Chris, the long-term founder-focused vision investors and Wall Street people, they have to make money by trading it. I'm putting a little exaggeration, but those two markets merge in crypto. So they take a perspective on public market perspective on private, and they take a private lenses on public, the token market. That's why people are keep confused and criticizing each other market. But I think from the beginning, I think it's just because they are different perspective lenses. I think there's no answer. I think to be more specific, I think it's almost like meaningless to talk about this. I think what Chris said is just a textbook the answer that to basically answer your question.
Thank you.
I would just add that VCs have the opportunity to extend fund life. If the assets are illiquid or it doesn't make sense to sell, there are opportunities to extend. And we've seen that when we're fundraising and you speak to people just being in the market. A lot of VCs and private equity funds and investors have been illiquid for a long period of time because IPO markets were closed. So I think it's more important to get to the right PMF than to rush anything out. And I would also point out that there are secondary markets. There are growingly mature secondary markets where if a fund does in fact need liquidity, they can sell their safe in a sophisticated way in a secondary market that should not disrupt continued growth of the project. They could also sell liquid tokens through an OTC desk in a way that doesn't, that they're not just dumping supply onto the market. So I think there are responsible ways to work on these things, and it's important that the VCs and their invested companies work together for this, what I would look at as a sort of a private to public market handoff. And I think we need to get better at that handoff.
I think part of the problem is that the public market is not as sophisticated in crypto generally as it is in the equity landscape. There's a lot of capital in public equity that will theoretically only buy the highest quality equities coming out, which disincentivizes or makes it impossible for venture to take something out public in the public equity markets that's just going to go down only. That said, we've been talking about IPOs, and before I was a crypto degenerate, I used to be a finance professor, and it's very well documented that, from primary market IPO, there's a huge bump on the first day, and then if you're buying on the first day of an IPO, that's a terrible investment strategy. And equities tend to trade down only for a while too. So this is not an abnormal phenomenon. It's just accentuated in crypto because the secondary market is primarily retail. And I think for the 2021, 2022, they were buying into whatever was coming out, whatever narrative, whatever KOL campaign was influencing them, and that was problematic. And I hope we'll see less of that going forward. And I think the sophistication of the secondary market has to go up for this to be a sustainable endeavor.
Thank you. I think we're running out of time, but one one last question. Can you predict how TGE will change in the next 12 to 24 months in one sentence?
We'll see far fewer of them.
Yes, yeah, I agree.
Increased emphasis on metrics and quality.
Yeah, I think people are wising up slowly, and I think the regulatory landscape should improve. Cross your fingers and knock on wood. And I think that'll make it a lot easier to slow the roll on decentralization. And I'm optimistic that a lot of this is a thing of the past, but you never know.
All right. Thank you, everyone.
Thank you.